Great. I hope you can all see my screen now. And
Yes, we can.
okay, I'll keep my comments to 15 minutes and hope that what I say is of interest. I'm very interested in the previous speaker, and I admire the efforts being made to create a tokenized real estate market. And I suppose my job or my role here is to speak as a conventional real estate person and point out why there are some limits to this market. There's a general real estate FinTech movement which is clearly following the broader FinTech world, and it's probably most broadly expressed through real estate portals for the housing markets, which are now very well established in most markets, and no doubt Denmark has got a dominant portal. I did some research on this, but I couldn't find out which one the dominant one was. In the US, we have Zillow, Zoopla. UK, sorry, we have Zoopla and Rightmove. These are dominant portals. We're also using data science to create residential valuation models, which sort of support the possibility of automated purchases. So businesses like Open Door and Nested have algorithms which enable them to value houses and make offers to buy those houses, like WeBuyAnyCar.com, we have WeBuyAnyHouse.com. And there's quite a lot of work going on to create digitalized transactions, which is a way away, but the whole digitalization of the transaction process, potentially using blockchain, is being talked about a lot. If we move into the more professional markets, the more sort of institutional markets, we do see some crowdfunding going on, but it's pretty limited in its scale. We see the possibility of using property passports and digital data as a sort of attaching to real estate assets. And then finally, which is of most interest to this panel or this session, is the idea of creating tokenized primary and secondary markets for units in commercial real estate and funds, and the question about how big that can become. So earlier this year, we produced a report on tokenization as it regards real estate. And in the very week that this publication came out, January 2020, we heard that a real estate exchange called IPSX had floated its first building in its London exchange. So IPSX is a traditional stock exchange for the sale and purchase of units in buildings. So every building is put into a company, shares in the company is traded through this dedicated exchange. The first asset has been put onto the platform. Now, when this happened, we were all very interested. Of course, the COVID crisis hit within 6 weeks. Whether the COVID crisis has slowed this down, whether there's been any investment or trading in it, is an open question. At the same time, in the same week, we heard about the Brickmark transaction of a building in Zurich. It was claimed to be the largest ever real estate transaction paid in tokens, 130 million Swiss francs, a significant part of the purchase price paid in Brickmark tokens. I understand that deal, which was successful in theory, was actually only created as an option deal and hasn't actually proceeded as a tokenization. And I'm pretty sure that the IPSX transaction hasn't happened either. So we're in a place where there's a lot of interest and quite a lot of activity, but not a lot of evidence of real success going on. This is despite the fact that real estate clearly, as the last speaker very correctly said, real estate suffers from illiquidity and also lumpiness. So you've got this asset class which requires very big tickets and is difficult to trade. So the proposition that if real estate assets were fractionalized, then you could produce better risk return characteristics for real estate portfolios because of more granularity, and you produce more liquidity. This is all true. This is all theoretically true. But I think the missing piece in this is that not a lot of real estate market participants want to see improved liquidity. I think Klaus referred to this to some extent. So it suits a lot of people to see barriers to entry, and liquidity has a price. Illiquidity has a price, and liquidity has a price. So, we would expect illiquid assets, private assets, to outperform liquid assets, and therefore a lot of participants aren't particularly keen on this idea. And non-digital fractionalization, which we could call crowdfunding, and many previous attempts to split buildings into small units have never been a big success. The amount of capital raised for real estate in Europe in 2015 to 2018 is the crowdfunding component of that is a tiny, tiny amount. As this graph shows, it shows that real estate crowdfunding has raised maybe 200 million euros in a 3-year period, which is not huge. So, does the market want fractionalization? Does fractionalization offer advantages? And are there other ways we can do this? What is the particular role that tokenization could play? Well, there are many alternatives to splitting buildings up, but all of them are difficult. Splitting freehold ownership between several legal persons can only be done up to a certain point. And there are limits in all of these traditional ways of splitting buildings up. So a digital fractionalization process could be extremely appealing if there is a perceived demand for this. The legal fractionalization of an asset needs to be permitted by relevant land law, and it needs to be made possible by a specific change in the law, or it's going to be some sort of contractual arrangement which sits outside land law. So would tokenization be a better solution than traditional fractionalization? The proponents of tokenization talk about avoiding regulations and tax, reducing fees, disintermediating brokers, speeding up transactions, maybe avoiding public information being made available and exploiting blockchain and possibly cryptocurrencies. But all of this to me is slightly idealistic. For the simple reason that the only way we can tokenize a building is to have some sort of intermediate structure. So we cannot split a building into lots of legal pieces and sell those legal pieces. There needs to be something in between. And IPSX, the stock exchange in London, is an illustration of this. In order to sell units in buildings, they had to put the building into a company. The company then trades the shares in those buildings. In the tokenization world, we're in exactly the same place. In order to trade shares in a building, we need some sort of intermediate structure, be it a company, a trust, a partnership. And we would then trade units in those structures. So this idea of having tokens on buildings, ignores the idea that you need this intermediate LLC, LLP, company, whatever. And of course, once you go through the process of putting the costs of creating the company or the intermediate structure in place, then you slow down the appeal of tokenization, because you can't achieve this nirvana of splitting a building into pieces and tokenizing those pieces. However, MIT produced a really excellent report last year on the technical issues to do with real estate tokenization. I think their report was balanced, it was on the fence. It certainly talked about the potential benefits of fractionalization, as the last speaker did. And these benefits are so appealing that it does justify the effort and the time involved in innovating and trying to perceive the way through this. But the problem that we must always bear in mind, this problem that we don't have a proven demand side. And therefore, if you're going to commit time and effort to producing these solutions, it's extremely important to understand the demand side of this. And I've got a pretty clear view that there isn't a tremendous demand side for single buildings, but there is a potential demand side for funds. And I'll come on to that point in a minute. In order to tokenize a single asset, which is where a lot of the chatter has come from, you need to create an untested market for units in single assets. And there is just not an active market for small pieces of single assets. Nowhere in the world can we point to a massively successful market for this. You need confidence in the promoter, which is often a startup. You need a belief in blockchain technology, so you need to be comfortable with that. And you've got to be prepared to transfer the asset into a corporate structure, this intermediate structure. One of the issues is that as soon as you create this structure, a lot of market experts will say that you'll create a bid-offer spread, greatly limiting the liquidity that you're trying to create. So in previous experiments of this type, we put a building into a company structure. We trade the company on the stock market. The shares in that company trade at significant discounts to the appraised value of the asset. It means that kills the market because the initial investors lose money, and it doesn't persuade anybody to put their building through this platform. So there's a risk, therefore, that the liquidity creates this bid-offer spread, and that bid-offer spread kills the demand on the supply side. And then the second issue is there enough effective demand to buy units in buildings to justify the expense of creating this platform? We know that the tokens that would be created would be security tokens. They would be regulated. The previous speaker spoke about Singapore, Switzerland, Liechtenstein, Luxembourg. There's clearly a regulatory arbitrage game going on here, where some jurisdictions are trying to win business by being easier to regulate or less regulated. The positive message that I'm going to try and put across is that real estate funds, this is the natural area for tokenization. So remember that you have to put the fund structure in place anyway to create a building. You need this intermediate structure. Well, the property fund is already in that structure. It's already going to be a company, a partnership, a trust. The investor base is already fractionalized. So people already expect to buy units in these funds. They don't expect to buy whole funds like people expect to buy whole buildings. They're buying units. So it's already a fractionalized business. The investors' rights are already established through limited partnership arrangements. Everybody knows what their rights and responsibilities are. The promoter is probably a recognized brand, a well-known financial institution, and the structure is already regulated. So to go through the regulation process, you don't need to do that, it's already there. There are no tax, accounting, or valuation issues that are likely to impede the development of a tokenized real estate fund market. And we're probably going to get some liquidity at NAV in funds because these are diversified assets. When you look at the tokenizations that are claimed, the number of semi-successful tokenizations, you'll see that in the fourth column here, there are very few single assets. Most of the tokenizations have either been single buildings which will become funds, or they're already funds. And I think this is a significant finding, that the best place to make progress and to sort of storm the gates is the best place to do this would be through the fund market. So my conclusion is that the work needed to justify the digitalization of data requires a lot of transactions. It's not obvious that there is a demand for that in the single building side. I think that there is a strong use case for utility tokens as well as security tokens. But there's a lot of money involved in putting a tokenization business together. It's in its very early days. There are lots of costs, as the previous speaker said. The real opportunities for the future are really in fund exchange platforms and in creating a liquid way and a cheaper way to access investors into these property funds, and then to create a secondary market for people to come in and out. And it's worth saying in conclusion that there is a lot of stress currently in the traditional fund market. Open-ended funds have been gated. The crisis in retail property in the UK and the US has meant that a lot of funds are in big trouble. This is exactly the right time to create a liquidity solution and a cheaper way of raising capital. And tokenization offers tremendous opportunities for that. So I think that's probably all I have to say, Mette. I'm very happy to answer any questions.
Well, thank you very much. Yes, you can hear me, right?
I can hear you.
Fantastic. Well, there are no questions in the Q&A. There are still a minute left, so if any attendees have a question, now is the time. But that was a really great talk. It was really informative, very informative. And,
great.
Also a little bit surprising, I think. So I'm surprised that there aren't any more questions about it. Because it does seem that most of the hype is in small fractions of ownership of larger projects.
Well, maybe we can pick this up in the panel.
Yeah, that would be good. I know that your moderator is listening in and preparing, so he probably has some in-depth questions for you.
Okay.
But otherwise, thank you so much, Andrew. It was really great. Thank you for participating, and we'll see you later.
Thank you.